Welcome to the Bigger Cash Flow podcast, where we interview business owners and real estate investors that share tips and tricks on how to grow your cash flow and reach financial freedom.
What's up, you guys? Welcome to another exciting episode of the Bigger Cash Flow podcast. Today we have Paul Moore on the show. Paul began his career at Ford Motor Company after earning an MBA from Ohio State. After 5 years of working at Ford, Paul started a staffing company with a partner. Paul and his partner sold it to a publicly traded firm 5 years later for $2.9 million. Along the way, Paul became a two-time finalist for Ernst & Young's Michigan Entrepreneur of the Year award. Paul later entered the real estate sector, where he flipped over 50 homes and 25 high-end waterfront lots, appeared on HGTV's House Hunters, developed a subdivision, and started two successful online real estate marketing firms. After helping with 3 successful developments, including the development of Hyatt Hotel and a multifamily project, Paul entered the commercial multifamily arena. Paul is also the author of The Perfect Investment, found on Amazon.com, Creating Enduring Wealth from Historic Shift to Multifamily Housing, and co-host of Wealth Building Podcast, How to Lose Money. With that said, let's welcome Paul to the show. How are you doing, Paul?
I'm doing great, but why would you want to talk to somebody who has a show called How to Lose Money?
I have no idea, and I'm sure you'll enlighten us with how you came up with the title. It's very catchy. It makes me want to click it right away. How did you come up with that?
Well, over the years, I got to know different people. I would go to these conferences and I would hear these amazing success stories, but I would look around the table or around the audience and see people kind of hanging their heads thinking, I could never be like that guy. I could never be that good. That guy just has a golden touch, and I just seem to have a lot of failure in my life. But I got to know some of those speakers, and I sometimes was one of those speakers, and I would say, wait a minute, these guys all have failures in their past. They all have problems. And on the occasion when I learned that, I would realize, wait, there's hope for me. And I'd actually feel better when I realized they had problems and failures. So when we started our podcast 3 years ago, we decided to interview successful people about past problems, doubts, losses, fears, failures, and see how they overcame them. And we want to give our audience hope, because there's hope for everybody. And I am really excited that everybody would realize, no matter where they are today, no matter what failures they've gone through in their personal, professional life, there's hope, because they can change and they can become all that they were meant to be. And every single successful person we've talked to has had massive failures and massive pain in their past, and they've overcome it. And you can too.
I love it. You know, they say every failure is one more step towards success. And I think that's really true. If you take a look at, the bios and stories of very successful people, they've had setbacks, but it's really how you come back from it that really sets their story apart, in my opinion.
Yeah, it's true.
Awesome. So let's dive right in. And if you can share with our audience a little bit about your background and journey in business, real estate, and entrepreneurship.
Yeah. So when I quit Ford, I actually loved Ford Motor Company, but when I quit, I had the staffing company, and it just was, everything went well. I mean, it was the right place, the right time. Everything was just perfect timing. And I found myself at under 34 years old with a couple $1 million in the bank. And I was thinking, I'm an investor now. And, I didn't know the first thing about investing, Bo. I confused it with speculating. Investing is when your principal is generally safe and you've got a chance to make a return. And speculating is when your principal is not at all safe and you've got a chance to make a return. And, Paul Samuelson, the first Nobel Peace Prize winner in economics from the US, said, investing should be more like watching grass grow or watching paint dry. If you want excitement, take $800 and go to Las Vegas. Investing, true investing, like Warren Buffett and others, often it's pretty boring. It's not as exciting as being an entrepreneur. And us entrepreneurs and investors are a pretty optimistic bunch. But sometimes that optimism can taint our view of what is a good investment. And so I've been on a path over these last many years learning to stop speculating and to really, truly invest, to be safe, to look for the signs of, a good, solid return. I've stopped trying to hit grand slams. I'm going for singles and doubles now. It's a lot more fulfilling to see my bank account and my investors' bank accounts grow, even though it's not as exciting.
I love that. So I mentioned it briefly during the intro, but so you have this very successful staffing company with your partner, and then you sold it. So after that, how did you really transition into real estate? Was that always kind of in the background and you became a little bit more active, or did you kind of, dive, feet first?
Yeah, so I started a nonprofit organization, which was like an international student ministry in the Blue Ridge Mountains. We actually were reacting against our living on the border of Detroit for 6 years and, seeing it implode before our very eyes back in the late, mid to late 90s. And so we actually bought 120 acres on top of a Blue Ridge Mountain in Virginia. And we started this international student thing where we had international students who were studying at various colleges like University of Virginia, UNC, Virginia Tech, and they would come for these weekend retreats and ride a goat and milk a cow or vice versa, or take trail rides or go fishing in a pond. And we had a great time with them. But I found myself getting a little bored because, I was a high energy entrepreneur in my early to mid 30s. And so I actually became a pretty bad version of myself. I thought I'm going to be this super father and wonderful husband. And because I was getting bored, it was more like semi-retirement. I got squirrely, I wasn't happy, and I had to find something to do. So my friend and I heard that you could buy houses on the courthouse steps at auctions for cheap. And so we went to an auction. Our first deal was we went there with no cash, no cashier's check, because we wanted to be disciplined, that we would not actually enter a bid on this house for sale. We had all the numbers worked out. We knew that this house should be worth $65,000 after repair, and there was no repair to do. We actually stuck our head in the windows. It was vacant. And we realized this house should be, we didn't know what it should sell for at the courthouse steps, but we knew it should resell for 65 or so. Well, we got there. We were the only people there on the courthouse steps on that icy day. And they opened the bidding at $34,000. Well, we told the auctioneer, we said, hey, wait, can we go to the bank and come back? And she said, I got to go to lunch. I'm suddenly very hungry. And she said, I'll see you back here in half an hour. So, and that was highly unusual, by the way, we found out later. And we met her back there. We gave her a check for $3,400. We bought the house for $34,000, sold it for $65,000, first day on the market 3 weeks later. So we thought, this is easy. And well, we lost money on 2 of our 4 next deals, found out it wasn't as easy as we thought, but that's how we got started. We did dozens and dozens of those flip houses, rent to own, lease option sandwiches. I flipped a whole bunch of lots. I actually built 7 or 8 houses myself and ended up finally transitioning to commercial much later.
Nice. So let's kind of talk about real estate and other, alternative asset types, because this is an age-old debate between investors. Some investors like real estate, other people like stocks, bonds, mutual funds, and even other types of investments like oil, gold, and, other commodities. But in the context or framing just this conversation, let's just compare real estate versus stock bonds and mutual funds. And if you kind of share with us your thought process in between deciding one over the other.
Yeah, well, Bo, interestingly, I've done every one of those asset types that you mentioned. First thing I want to do is look at the Sharpe ratio. That's SHARPE. The Sharpe ratio measures the returns as a function or divided by the volatility or the risk. And the Sharpe ratio for commercial real estate is many times higher. The higher, the better, by the way, because the return divided by the risk, in other words, it's much higher for commercial real estate than it is for stocks, stocks or mutual funds. I can't actually remember what it is for bonds, but you've got the S&P 500, you got the Dow Jones Industrial Average, and then you've got private equity, which is quite a bit higher, surprisingly. And then you've got commercial real estate, which every class of commercial real estate is much, much higher. In other words, the Sharpe ratio is much better. At the top of that group, we have multifamily, self-storage, and I don't actually know for sure if they've measured mobile home parks, but I would say, based on my knowledge of that area, that would be the highest of all. In other words, the highest return divided by the least volatility. So you've got a Sharpe ratio that's much, much higher for commercial real estate than other asset classes. Now, another thing to think about is this. Imagine a continuum in your mind, Bo. From at one end, you've got stocks, bonds, and mutual fund. So they're highly liquid. You can cash them out anytime you want. You've got great flexibility. But you've got people like Buffett saying you shouldn't cash them out anytime you want. You should set it and forget it. He says he wishes that after a stock opens on the stock market, they could just close trading for that stock for like a decade and people would be way better off. But nevertheless, those people do have the flexibility that they might want. They can cash it in, they can trade it at any time. That's a benefit to a lot of people. And if you're the type of person that wants to trade in and trade out, that's a benefit to you, and that's a benefit that commercial real estate doesn't have. It is highly liquid. Now, on the downside, on that same end of the continuum, you've got, the stock price doesn't have a real clear path from operations to distributions to the actual amount you see in your bank account. It's just not clear. It's clouded by sometimes a war in the Middle East, or sometimes a CEO scandal, or the mood on Wall Street. Those are all affecting, and it's not even always clear that there is a direct path from, again, raising rents at the property level to the actual amount in your bank account. So that's one end of the continuum. At the other end, you've got commercial real estate. It's not liquid. It's illiquid, and it's a big disadvantage to people who want liquidity. However, it has stability, it has predictability, and it has transparency. It has a real clear path to, okay, we're raising these rents, we're doing these things at the property level, and it has a direct impact on my distributions as an investor and the appreciation that I get. So that's the continuum there. And if you want that flexibility, you might want to be in stocks and bonds. I will say that studies have shown that I think 93% of people who trade in and out regularly lose money. And my vote's with commercial real estate.
I really appreciate that explanation there. It's funny because I work with a half dozen private lenders for some of my BRRRR deals. And it seems to me like some of the people that are on the fence often come to me and say, hey, Bo, is there a deal that you have that I can invest in when the stock market turns? So recently there was another turn, and I had another investor came up to me and be like, hey, I made up my mind. I want to invest in a deal or something like that. And for me, when I was doing my research, of course, there's numerous articles and blogs about some of the things that you said about the pros and cons for both asset types. But also I ask other investors and they would just say, hey, everybody needs housing, and, in terms of why multifamily real estate is superior. But I didn't know about the Sharpe ratio, and that's very interesting. I got to look a little bit more into that. But I think you're exactly right. The risk and reward is sometimes huge because, like you mentioned at the beginning of the show, if you're really risking your capital and also not understanding fully the extent of, that mutual fund, you don't know the portfolio manager, I'm pretty sure, I worked at a mutual fund for a year. I'm pretty sure not a lot of people understand what's included in the 12B1 fees and all of the other fees and included in the expense ratios of these mutual funds. So there's something to be said about having control if you're a GP, or just having stability and predictability, like you said, if you're a limited partner on these deals.
Right. I just saw an analysis from my friend Michael Blanc, who is a multifamily trainer, syndicator. He said, and I don't have the numbers exactly right necessarily, but I think he said the 10-year returns in the stock market have averaged something like 7%. But when you take out the fees, you're down to 5.5%. And when you take out the capital gains taxes, you're down in the 4% range. Commercial real estate, if done right, can often have cash on cash returns from operations of 6 to 10% or more, and then appreciation on top of that of another 5 to 10% per year or more. And so now, of course, the rising tide of the last 11 years since the trough of the recession has made it easy for a lot of people to make money. That's another Buffett principle that we want to have, and that is we want to invest in assets that are recession resistant and have a margin of safety. So in other words, in good times, we're trying to invest in assets that might have a 30 or 40 or 50% annual return. I know that sounds crazy, but I've got tons of data on this. And then in bad times, hopefully they'll still have a 10 to 20% return. And that's the type of things where Wellings Capital is investing in.
Awesome. And, like I mentioned earlier, you've authored the book called The Perfect Investment. And aside from some of the things that you've already covered right now, what are some other attributes that make multifamily and commercial real estate the perfect investment?
So multifamily is an amazing investment class. And like I said, I not too arrogantly called the book The Perfect Investment. What do I do with a self-storage book now, though? The Perfecter Investment? I don't know. But anyway, that's another story. I do have a self-storage book coming out next year. I'm hoping it's going to be published by Bigger Pockets. But if not, I've got another backup. But at any rate, the multifamily was driven by this. So in 1995 or so, the U.S. federal government, in its great wisdom, said that anybody who can fog a mirror deserves to own a house. And so they mandated all these rules on mortgage companies and banks saying that you've got to loan more money to people to get houses. So if they had an okay credit score, no money down, no good income, they basically could go in and they could do a no-doc loan, or they could do a no money down loan, or they could even get money back. I saw people getting lots of money back, buyers at closing, crazy things. And so the home ownership rate in the United States, Bo, that had been historically hovering around 64%, shot up to 69.2% by the year 2005, in a decade. But lots of things happened, and people started, they stopped paying their mortgage. They started realizing they couldn't afford their overpriced house. I knew a guy who made about $45,000 a year, and he bought a $600,000 McMansion in his hometown where he grew up, a state away, to impress his friends, as a second home. And he only made like 1 or 2 payments on it, and he lost it back to the bank. And that was happening more and more. And what happened is, we all know that there was an economic downturn in 2007, 8, 9, and people started losing their homes, and the home ownership rate crashed back down from 69.2% to about 63%. Now, every 1% drop in that rate resulted in 1 million new renters back into the renter pool. But something more important happened then, Bo. People who had for decades heard that the American dream was owning your own home realized, maybe this isn't my best investment. Maybe this isn't the greatest place for me to have my wealth. They saw their parents or their friends or their, millennials saw older people losing their homes, and some of them lost their homes, and they said, I don't really want to do this anymore. So you've got millennials being the first generation that we're aware of, and one of the largest generations in American history, pretty much tied with baby boomers at 77 to 80 million strong. You've got them saying, I don't really want to get tied down to a 30-year contract on a seemingly overpriced home when I may have new opportunities, new friends, new jobs across town or across the country next year. And so they're renting more than buying. A lot of them have record high student and other debt as well. So it makes it harder to buy. And of course, banks had tightened up their restrictions at the same time. So it was a perfect storm for millennials. Now you've got baby boomers. They're the smallest renter group, but baby boomers are the fastest growing group of renters. And statistics say once they begin to rent, they'll never go back to buying again. A third group is immigrants. Immigrants rent more often and longer than any other group. And the number of immigrants in the U.S. is growing faster than any other group by far. I've got some statistics on this in my book, The Perfect Investment. The fourth area that I didn't cover in my book is Gen Z. Now, Gen Z is almost as large as the millennial group, and every indication we have right now is that they're going to be a group of renters more than buyers. All that is to say, multifamily has great demographics and great long-term prospects. And if I had $1 million to invest and I couldn't touch it for 100 years, I would invest in multifamily, hands down. But the problem is right now, multifamily is very much overheated. And has it reached its peak? We'll never know until we look back in the rearview mirror. But it sure seems like the returns are crunched down to a very low level. In other words, the cap rates are very low, meaning the return on investment and the margin of safety is very low as well. And it's a time when I've backed off and felt like I am pretty gun shy of investing in the perfect investment.
If you're looking for insurance coverage for your rental properties, the company that I trust is Ross Diversified Insurance Services, a national insurance agency that has been providing insurance coverage for real estate investors for over 30 years. Whether it's a rental or a fix and flip, Ross provides you coverage through A-rated insurance carriers to provide you with competitive rates, as one size does not fit all. Check out biggercashflow.com/RDIS to get your free quote today. When you're purchasing your first property or the next, you want to work with an experienced lender who's got your best interest in mind. Sean Huss at Chemical Bank has been a professional in the mortgage industry for over 25 years and has helped hundreds of investors like you and me grow their rental portfolio. With expertise in areas such as real estate sales, title and escrow, and the mortgage closing process, Sean is able to provide comprehensive counsel to guide you throughout this often complicated process. Check out biggercashflow.com/chemicalbank to get pre-qualified for free when you mention the Bigger Cash Flow podcast. That's a great actual segue into the next conversation. Is my question was going to be, okay, so in 2019, right now, because that's even different from a year ago or 5 years ago, 10 years ago. So, how should investors approach the perfect investment, right? Because you mentioned in the past, you kind of went for the grand slams, the home runs, but now you're going for these singles and doubles and you're perfectly happy. So, investing is speculating. What would you consider a speculative investment in commercial real estate at this time? And how can investors be a little bit more careful when growing their portfolio?
Yeah, so Rod Khleif was on my podcast, and Rod Khleif said that he was investing for appreciation in Florida in the early 2000s. And he said his portfolio, his net worth, grew $30 million in the year 2006 alone, if I'm not mistaken. And then he said between 2007 and 2008, his net worth dropped by $50 million. And it was because he was investing for appreciation, not cash flow. If you're counting on appreciation to make your investment work, then you are speculating. If you are counting on safe fundamentals and cash flow for your investment to work, then you are more likely investing. And then you're viewing appreciation as a cherry on top of the sundae, a nice bonus if you get it. I would say right now that, if you're counting on the cap rate to continue to compress, if you're counting on appreciation, if you don't have solid cash flow, you have to get a significant raise in rental rates. And you're counting on decreased costs as rents continue to go up, you might be in the speculative range right now, and it might be a dangerous thing. By the way, I want to be really clear. People have made tons of money speculating. It's okay to speculate, but just be sure that you know that you're doing that, and also consider the wisdom of financial planners and others who say you should only speculate with perhaps 10% of your money, certainly not all of it.
I love that. Okay. So let's kind of segue into, the perfect investment in the lens of a limited partner. So like you mentioned, over the past, I don't know, at least like the 4 or 5 years that these multifamily gurus, for lack of a better word, seem to be doing a lot more boot camps and getting a lot more students to do some syndications. I see it all the time, and they send me packets. And my audience might be wondering, okay, I get one of these packets. I'm very busy in my W-2 job. I'm a doctor, lawyer, and I don't have time to be a general partner myself. But how can I underwrite or, risk mitigate these packages to make sure that if I want to invest as a limited partner, I'm doing so very safely and securely?
Yeah, I think the most important thing is actually vetting the syndicator, vetting their track record, and asking yourself, have they been investing in this asset class with this strategy through and before the last recession, maybe even 2 or 3 recessions? And so you're looking for a team, not a scattered group of 1099s. You're looking for a team that's worked together, a team that is coherent, a team that's clear on their mission. You want to go in and vet them. You want to talk to past investors. You want to ask them about their worst deal, find out what they did when that happened. You want to talk to past and current employees. You want to see how they treat the waiter at the restaurant. You want to look in their eyes. You want to get a gut check. It's really, really important to get to know the syndicator or the sponsor and really understand, that your interests are aligned with them. We've got a checklist, a 21 point checklist that we go through to try to vet an operator. That's the most important thing Wellings Capital can do. It's what Warren Buffett and Charlie Munger do. Did you know that they made their largest investment to date in the 80s in Tom Murphy and Capital Cities ABC? When Capital Cities was buying ABC, they made that based on a 15-minute phone call with no other due diligence, no site visits, no anything. 15-minute phone call, and they decided to invest billions and billions of dollars in this acquisition of ABC. It was because Warren Buffett trusted Tom Murphy. Warren Buffett vetted the jockey, and because he vetted him very carefully, he was ready to make that investment really quickly. It sounds like maybe a speculative type thing to throw billions of dollars at something like that, but of course it went very, very well because he trusted the operator. So I'm hammering this point. I really think it's important for your investors, for your listeners, to really, really vet the operator first, the deal second, the jockey first, the horse second.
Gotcha. Yeah. So understand who's really steering the wheel, who's the captain of the ship, understanding their track record. I think that's really important. In terms of any tangible, metrics, and I know it's very difficult to, cover in a 30, 40-minute podcast episode, but are there any assumptions? Because there are lots of assumptions, whether you're estimating the exit cap rate or rents are going to increase or how you're going to reduce expenses, that when you look at it from another syndicator, you're like, ooh, I don't know about that. That's a stretch. Are there anything like that?
Well, if they're assuming, for example, that rents are going to go up 5% the first year, that vacancy is going to drop the first year, that expenses are going to go way down the first year, I'm already a little suspicious. If they're assuming that the rents are going to go up, let's say 3, 4, 5, 6% a year, every year for 5 or 10 years, I'm going to be very suspicious. If they're assuming that their HR costs, their staffing costs, and their other expenses are going up at a fraction of what rent's going up at, let's say rent's going up 5% a year, but they're assuming their costs are going to go up 1 or 2 or 3% a year, I'm going to be suspicious. If they're assuming a cap rate exit, I don't want to really compare it to the entry cap rate because that is another discussion. But let's say the cap rate in general today I'm making this up, Kansas City is 6% on a certain type of asset. If they're assuming a 5% exit cap rate, in other words, more expensive at the end, quite a bit more actually, then I'm going to be suspicious. Now, if they're assuming modest rent growth, modest decrease in vacancy, actually an increase in vacancy the first year, flat rents the first year, if they've got really good justification for why rents will go up, based on prior poor management, hopefully, if they've got maybe a 7% cap rate as the exit rather than a 5, let's say again it's 6 today, then that's going to be a lot more believable. I'm also going to be looking to try to figure out if our interests are aligned. I'm going to be seeing, what do they get out of it? Do they get a hefty acquisition fee? Do they get a hefty fee at the time of refinance and exit? Do they get paid really well regardless of whether the investor makes money or not? I'm going to be wondering about that as well. Those are things we're going to be looking for. There's a debate about whether a preferred return is really in the investor's best interest or not. And if you want, we can talk about that for a minute.
Yeah, let's definitely do that.
So a preferred return means that when money comes in, when there's distributable cash flow, the investor gets the first X percent. It's typically 8-9%. And then after that, there's a split between the investor and the syndicator. Well, it sounds obvious that that's best for the investor. That means their investment looks a little bit more like debt, not completely guaranteed like debt, like interest on debt is, but basically that they get the investor gets the first cut when money comes back in. Well, there's some people who say that's not helpful because this hurdle, it causes the syndicator to have to take larger risks trying to get larger returns. Think about a graph in your mind. Low risk leads to low return. High risk leads to, well, people would think high return, but it's actually the possibility of higher return. It's also the possibility of great loss, and that's getting out in the speculative area. Well, because they have to pass this hurdle to make any money, it causes the syndicator to potentially take higher risks, and that might not be good for the conservative investor. Another thing it causes is in the first 1, 2, 3 years, if things go really poorly, it might cause the speculator to give up. Because a year or two in, if they haven't met their preferred return, that preferred return is accumulating or banking for future periods. So if there's an 8% pref and they only distributed 2% the first year and then 3% the second year, well, now after 2 years, they've got 16% they've got to make up less the 5 they paid. So they've got 11% they're behind. Well, the syndicator might just throw up their hands and move on to something else. And though they're still operating the property, they're pretty much realizing I'm working for free. And they might just not really act in the investor's best interest at that point. So those are some things to think about. I don't have an answer on that. We still use a preferred return. We give our investors a 9% preferred return, but we have to think about that in the future.
Yeah, I think that's a very interesting perspective, is, just taking a step back and looking at the whole forest and not the tree.
Right.
So I think that was a perfect example of why there are some other considerations and not just one way of doing things.
Mm-hmm.
So you also talked about aligning your interests, and that's another great point in terms of, making sure that, does the syndicator have skin in the game, right? Would you ever invest in a deal where the syndicator doesn't have skin in the game? And if so, why or why not?
Oh, that's such a painful question, because Here's the thing. My mentor, if you ask my mentor, who's solid, they've given incredible returns to their investors on, as far as I know, every deal for about 12 years. They've done very, very well. And but if you ask them, do you have skin in this game? They'll confidently look at you and say, no, I don't. And here's why. And I've heard this answer from 2 or 3 syndicators. They say, I don't because I have to sign on the loan. I have to have a sufficient net worth built up, sufficient liquidity, money in the bank or money that's liquid, so I can sign on this non-recourse loan, which is going to benefit all of you. Okay, so I don't invest in my own deals. And I've heard that from 2 or 3 sponsors. And I go, oh boy, that's a really good point. It's hard to refute that. At the same time, Bo, we all know that when people have their own cash at risk, they act differently than those who just have their time at risk. So I will tell you that one of the main, I've just given you both sides of the argument there. One of our main criteria for people we invest with is that they have their own skin in the game. One of the companies we invest heavily with right now, the Syndicator, the sponsor, put in the first $1.4 million of the, I think, 15 million that are in there right now. And I think they just invested $1 million more. And he said to me the other day, he said, why would I not? He said, I can't get a return like this anywhere else. Well, that gave me real confidence. And right now they're looking at a deal that we're scratching our head at. We're going, we're not sure we would have done this deal. But we have to ask ourselves, yeah, but don't forget, he put a lot of his own cash into this. That helps us when we evaluate it.
I love it. Simply put your money where your mouth is, right? So
right.
If they're doing that and just they're leading the pack, and you might be more confident to take another look at it to see if
right.
it's for you. I love it. Well, we're nearing the end of our show, and I definitely want to understand a little bit more about Wellings Capital, what you guys do, and your strategy for 2019 and beyond. So if you can share with our listeners a little bit more about your company.
Yeah, so Wellings Capital was a multifamily syndicator. And we were looking at the market and year in and year out going, gosh, we're in our 50s. We don't want to take these inordinate risks. We keep getting outbid on multifamily deals. And we decided, should we maybe look outside of multifamily? And we finally, very reluctantly, looked at self-storage and mobile home parks a year and a half ago. And when we looked at them, we were surprised, almost shocked at the number of mom and pop owners in those arenas and all the potential deals that could be had. There are 53,000 self-storage facilities in the U.S., and that's about the same as the number of Subways, McDonald's, and Starbucks combined.
Wow.
But a large number, perhaps 30 to 40,000, are owned by mom and pop owners. They don't maximize income. They don't maximize value. They don't either know how or care to because they're making enough money as it is. And so you can pay them a fair price. You can actually give them, you can buy their property at a very low cap rate, which means it's a really good deal for them. But then you can go in and add U-Haul, and that adds like $3,000-$4,000 a month to the income. You can go in and add different, climate-controlled units, locks, boxes, tapes, scissors. You can do a lot of things to grow the income, which massively increases the value of the facility. I should have hit this earlier. If you are investing in residential real estate, the value of the property is based on comparables or comps, okay? And we all know that. If you invest $800,000 in a $300,000 house, you're probably not going to get that out when you sell it if the rest of the neighborhood's $300,000. And we all kind of know this, but it's not that way in commercial real estate. The value is based on a formula. The value formula is value equals net operating income divided by rate of return, or NOI divided by cap rate. And so if you can expand the NOI, the net operating income, and if you can do things to compress the cap rate, and that's a longer discussion, you can dramatically increase the asset value. Well, if you can increase the asset value by, say, 30%, in other words, the net income basically by 30 typically, that's great. But leverage allows that 30% to be perhaps as high as 90% increase in the equity value. In other words, 90% appreciation of the equity on top of the cash flow. Well, those are the type of deals we are doing regularly in the self-storage and mobile home park arena that was very hard to find in multifamily, because 93% of multifamily properties are owned by corporations. Most of them have already wrung the value out of those assets, and that's why the margin of safety is very low in multifamily. I know I just said a mouthful, but anyway, that led Wellings Capital to wanting to invest in self-storage, mobile home parks, and to a limited degree multifamily. We realized we didn't have the team who had lived through the recession. We wouldn't meet our own criteria for somebody we wanted to invest with. So we didn't want to be the operator. We decided to go out on a quest to find best-in-class operators in every one of those arenas, and we are now investing heavily with them. What we're doing is we're finding these great operators that have these great deals, but maybe they're not as famous, maybe they don't raise as much capital as others because they're focused on operations. We're pulling together our investors, accredited investors who invest $50,000 or more can invest with us, and then we're putting that money into all these different great operators' deals, and we're giving them a diversified portfolio, great returns, tax benefits, cash flow, and we're allowing them to be hands-off. They don't have to quit their day job. They can allow us to do the heavy vetting, and that allows the doctor or highly paid dentist or attorney to stay with their day job, but to get the opportunity to be part of these great deals that they usually wouldn't know about otherwise.
That's awesome. So you're doing a lot of the legwork for them in terms of finding the best in the business, and you're just really partnering up with industry experts in self-storage, mobile home parks, and these other types of asset classes where you think that it's not as tapped out yet as just regular apartment buildings.
Exactly.
Is that correct? Okay. That is awesome. So we're near the end of our show. If you can share with our listeners how they can get in contact with you, find out maybe more about upcoming investments, if you could share with them.
You bet. You can reach me. You can check out our podcast, How to Lose Money. It's howtolosemoney.com. And hopefully you don't have a story for us there, but Bo, if you'd like to be a guest, let me know. You can also check us out. The main way to find me is at our website. It's wellingscapital.com. That's WELLINGS, wellingscapital.com. I'm also on Bigger Pockets. And like you said, you can find my book on Amazon.
That is awesome. Yeah, when I saw your podcast title, How to Lose Money, I immediately thought to my very first investment. As my listeners know, I lost a couple $1,000, not doing my due diligence fully, but that's what led me to create this podcast and just share my journey step by step with my listeners in terms of how not to lose money and don't do what Bo did in the beginning. So yeah, I'd love to be on your show and to share that story one day. So.
All right.
Well, Paul, I really appreciate you coming on this show. I'll have all this information and more on the show notes for this episode. If you thought that was helpful, please do me a favor and leave us a review on iTunes. We'll see you right back here next week for another exciting episode of the Bigger Cash Flow Podcast. Thank you for listening to the Bigger Cash Flow Podcast. Please remember that opinions of the guests are their own, and nothing on this show should be considered personal or professional advice. Please consult your tax, legal, or financial advisor for personal advice that fit your unique situation. See you next time.